Divergences in trading are quite common signals of technical analysis. These are basic early signals indicating the trend reversal and filter false signals. But in my opinion, they are very strong, and despite many times being called basic, they can make some trouble when interpreting them on the chart. So that is why in this video I make a detailed overview of convergence and divergences. So first, let's discuss what is a divergence in trading. So divergence is defined as a case when the price of an asset is moving in the opposite direction to a technical indicator, such as an oscillator. For example, the asset price is moving up, but the oscillator line is moving in the opposite direction, like in this Euro-USD chart. You see from the chart that the next price high, marked with the blue line, is higher than the previous high. The MACD serves here as a divergence indicator. However, the MACD indicator signals are down move. So you can see that the histogram of the divergence indicator is getting close to zero. The signal is accurate as the price reverses down, running a little ahead. I will say that this example is a simple bearish divergence. It is also called negative divergence. And so negative divergences occur when the underlying security moves to a new high, but the indicator falls to record a new high and forms a lower high. So, trading signals of divergences. Okay, now we know what are we going to talk about. Let us explore all possible types of divergences signals and analyze their examples in the charts. And although divergence is a simple signal, many people are confused with divergence trading. It happens because there are many types and classifications of divergences. In general, divergence comes into the following types. Number one, so we need to know, is it a regular or simple, in other words, / hidden or extended? Number two, is it bullish or bearish? And number two, is it negative or positive? Number four, is it direct or reverse? And number five, is it divergence or convergence? So these are the 5 subtypes. So such diversity can be confusing sometimes even for professionals. But in fact, trading divergence is easier than it seems. So first, let's talk about the double tops and double bottoms. So to understand all types of Forex divergences, we should first learn how to identify a divergence in the market. So irrespective of the divergence type, all signals are based on 3 principles. Number one, the primary feature is when a double top or double bottom pattern appears in the price chart. Differently put, there should be 2 manifested highs or lows in the chart. So what is important? The extremes must appear in the trending market. So you can see that there is no double top in this example on the right. The highs are not explicit. So therefore, there is no divergence signal. So number 2, which is principle number 2, we could say, any divergence is discovered only according to the highs or lows in the price chart and on the divergence indicator. So the chart on the left displays the correct divergence interpretation. The line connects the local highs of the double top of the price and the indicator. So the chart on the right is an example of the wrong reading of divergence. And so the price highs are compared with the indicator lows in the wrong way. Principle number 3. Price highs and the indicator highs should correspond to each other. So the chart on the left displays the correct analysis of divergence. The indicator highs coincide with the price highs at the double top. So the chart on the right displays a situation when the price highs and the highs of the indicator do not correspond to each other in time. And so, now let's talk about types of divergences. So now you can easily spot a divergence in the price chart. So let's explore different types of trading divergences. Basically, as you saw, there are 3 major types of divergence. There is a regular divergence, also called a classical or normal, hidden divergence, and extended or other words reverse divergence. And so this table outlines basic divergences. You can see also that each divergence type subdivides into bullish and bearish, which is a negative or positive. In general, regular divergence signals the trend reversal. Other types, of divergences, which is the hidden and extended, signal the trend continuation. And they are also called reverse divergence. And so many confuse the convergence and the divergence. So let's clarify which is which. Diverge means to deviate. In trading terms, it means any deviation in the price trend and indicator. Convergence is the opposite of divergence. Convergence derives from the Latin word convergo, which means get close. Therefore, convergence is a type of divergence when the price trend and the indicator line are meeting. So, now let's discuss regular divergence. So let's start with the regular one, which is a strong reversal signal. To spot bullish divergence, you need to analyze the price lows and the lows recorded by the indicator. The price chart should hit a lower low, but the indicator should signal a higher low. So blue lines in the chart mark the regular bullish convergence. The price hits a lower low, forming a lower bottom pattern, but the MACD paints higher lows. And so trading such regular divergence signal a soon reversal of the bearish trend. And so to find a regular bearish divergence, you should analyze the price highs and the highs painted in the indicator. So the price should be making higher highs, but the highs on the indicator are getting lower. So the regular bullish divergence signals that the bull trend should turn down soon, as you could enter short trades. And so, this chart displays the regular bearish divergence. The security price hits a fresh high, but the MACD histogram fails to break through the previous highs. Therefore, the price trend should soon turn down. So now let's talk about hidden divergence, other words, convergence. So now we move on to hidden divergence, which is the opposite of the regular divergence. It suggests to us the trend continuation. So a hidden bullish divergence occurs when the price hits higher lows while the indicator forms lower lows. So as you can guess, a hidden divergence bullish signal appears in an uptrend, and as I stated previously, it suggests the trend continuation. And so the left side of the table displays an example of a hidden divergence. And here you can see on the chart as well. The price lows connected with the blue line above are getting higher. The MACD lows are getting lower. Therefore, there is a hidden bullish divergence. That means the trend continuation. So to spot the hidden bearish divergence, we shall analyze the price highs. The price following a downtrend is making lower highs, while the MACD is hitting higher highs. A hidden bearish divergence appears in a downtrend. It means that the extended reversal is false and the trend is likely to continue. And so it is displayed on the right of the reference table and in this chart, which shows a bearish hidden divergence. So the price highs are getting lower, while the MACD highs are getting higher. So the trend hasn't turned up and the downtrend will continue. So next is extended divergence. It is similar to the hidden divergence. However, the extended divergence often fails to observe the basic rules as it frequently occurs in the sideways trends, and also it doesn't feature clear price highs or lows. Therefore, many traders do not consider the extended divergence as a trading signal, suggesting it can be a false one. So, as for the principles, extended bullish divergence is accompanied by rising lows. In the bearish divergence, the highs are getting lower. So let us see, of course, the example right here in the table. This screenshot displays the extended bullish divergence on the MACD indicator. The price lows are roughly equal. If you are not sure, remember that slight deviations are of course acceptable. However, the MACD second low is higher than the first one, and so this divergence signals the uptrend continuation. Next one is a bearish example. So the bearish divergence is also identified based on the indicator data. The MACD paints a lower high, so it means that the price will continue falling. So one could enter a short position. And so this Euro-USD chart displays the extended bearish divergence MACD, which suggests the downtrend will continue. So there could be slight deviations, but the highs are roughly equal in the first and second charts. And so as for the signal, it appears in the sideways trend, which is a typical feature of the extended divergence. So now let's talk about the common mistakes when trading with the divergences. So beginner traders often come across false information about the divergences on the internet. And so that is why let us discuss the most common mistakes when trading with divergences. So number one, on many trading websites, I noticed the authors wrongly identify divergence. They suggest that if the indicator is moving up, the line drawn across the indicator peaks is showing real highs. Based on this, they connect the highs in the price chart with the line. And so similarly in the case of downtrend, when the indicator highs are below the zero line, they connect the price lows in the chart. In other words, they believe that if the indicator shows a decrease, they need to connect the lows. And if it shows an increase, then they connect the highs. So they do it opposite of what it should be. So what you should remember is that you should always start with the price chart when trading divergence. First, you find the price extremes in the chart, ideally a double top or double bottom. Next, you explore the indicator data to find a divergence. And so the second most common error is when traders identify divergence simply by connecting adjacent peaks of the indicator bars. But they do not monitor whether these peaks occur within the same trend. So what is important? To spot a real divergence, you need to compare only the price extremes within the same period. So another example of a false divergence. When traders think that if in the indicator chart there is an upward slope and in the price chart there is a downward slope, this is convergence. It is of course a mistake. You must remember that divergence is determined by the divergence of the highs or lows of the price and the indicator, not by the direction of the lines. So many traders also make a mistake when they realize the divergence of the price highs and the indicator lows. So the next point is that if you discover a divergence, make sure that the indicator highs and the price occur at the same time. You should not analyze the price extremes that occur at different times. So the next point is that the divergence, being an early indication, features quite many false signals. It is a big mistake to trade only according to divergence. Another point, do not consider the divergence that has been followed by the price moves. They must have worked out. If not, they are false ones. So you shouldn't trade on past divergences. Next point. Another common mistake is thinking that divergence is only a reversal signal. So depending on the divergence type, as we spoke, it may signal both a trend reversal and continuation. So that would be the end of the first part of this mini course on divergence. Right now you can already discover the divergence signals. So open your trading terminal right now and try to find divergences yourself. Then go back to the video and check if everything you found is clear and you identified signals correctly. Practice is the best way to remember theory, of course, right? Okay, so thanks for watching and I'll see you in the next part.